So, are we about to enter into the largest buying opportunity of a lifetime? Are we about to enter into the biggest sell-off in property that we have seen in the last decade, maybe even possibly a lifetime? So, I'm Harvey, remote property investor, and I am going to discuss the autumn budget, not budget, kind of felt like a budget, the autumn statement what got announced yesterday. See what the effects are on the market, what it looks like for us going forward, and what we should be doing as property investors to navigate these very, very, very strange times, but in my opinion, very opportunistic times. Warren Buffett says, observe the massives and do the opposite. So more millionaires get made in a recessionary time than any other time in history. That's fact. Big companies like Uber, WhatsApp, Slack, who else? There's tons of them. Put them in the comments if you know any other companies. But in the '08 crash, loads of big companies emerged off the back of that. So you can either see this as a time of fear or you see this as a time of opportunity. If you brace yourself incorrectly, you educate yourself and learn how to navigate these waters, you are going to be in for a massive opportunity. But before we get into that, if you haven't done it already, please hit that like button. Please hit the share button. It really, really helps. My wife's living my terms. I'm mission to help with many people living their terms. But let's look into this autumn statement and let's see how it's affected the market. Have we had a kwarteng, I can't help but even doing that, a kwarteng effect on the markets with this autumn statement like we did from the ill-fated mini budget. So let's go into the points of what's happened in there, some of the big movements. So, look, there's taxation coming, and to be fair, I think it's inevitable. There's no way a country could print the amount of money that they printed during and throughout COVID without us expecting to be able to pay that back at one point. The deficit's wider than it's ever been. The only way the government really know how to try and reduce that is by taxing. Unless you're Liz Truss and you try to do that by growth. I like the sentiment behind what she was doing. I just feel the timing was very, very wrong for the confidence in the market. But let's have a look what happened in this autumn statement. So 45, and it's very contradictory against Liz Truss one, but 45p tax bracket has been moved. We're still going to keep that. It was going to be abolished before, but it's going to be moved down. There's a massive drag stealth on with inflation, but basically wages are going up, so minimum wage is going up, but there is a drag stealth tax that's like involved with that. CGT, capital gains tax, is going to be slashed. This tax-free dividends again going to be slashed. Energy cap is going to be moved, so the date it was capped to, it's going to go up from that. Minimum wage, as I said, going up. I've repeated myself. Social accommodation rent rise at 7%. Instead of the previous 11%. So that cap is going up. C-tax cap is going up from 2 to 5%. Levy on energy on companies, there's a big change on that. Road tax on electric cars, and basically a massive shift towards taxation and tightening of the strings. So look, first thing to say is government come out with a lot of promises and they don't always go through all the way to the end. So some of this might be just posturing to try to settle the markets back down, because the markets have reacted pretty neutralist. I've looked on here, and no matter where you read online, you'll get a positive and a negative view of things. But basically, if you type in market reaction to autumn statement 2022, the first headline comes from that touches on this comes from IICO. I'm not looking for that one. The first one comes from a Telegraph, says record fall in household incomes erased by a decade of growth. This is just straight on Google. If we just Google this and look at in order, I'm reading this in order. And cityam.com says market reaction to autumn statement, a fire cry from the mini budget, which we can all agree on that. Next one is UK market take autumn statement in stride. That's from the Financial Times, which is pretty reputable paper. Investment Weekly says autumn statement markets remain calm. Autumn statements, a real estate perspective. And it says, in a bid to calm the turbulent markets and reduce the impact of climbing interest rates on home owners, it stops there. And Frank Knight's autumn statement. There's a few ones in there, but at the moment, the pound has dropped a little bit, but it was dropping before this got announced. It's not dropped significantly like it did with the ill-fated mini budget, but it still had a little bit of a wobble. But as a grand scheme of it, the markets have reacted pretty neutral to it. There's been no major excess of the market and no major problems in there. So let's go over each of these points individually. So 45p tax bracket has been brought down from 150k to 125k. So now, when you hit 125k's worth of earnings, you're going to be starting to pay the 45 tax bracket. So this affects about 1,200 quid on higher rate people. There's a drag stealth, so wage inflation has been 6%. So wages are going up. Obviously, there's been a where is it? There is a 7%. Sorry, I'm mixing up my bits here, but there is a raise on minimum wage as well, which is going to put obviously inflation up on wages. But in real time, wages are behind inflation. So wages have been up 6%, but inflation is around 11%. So this is kind of a dragged. They're going to form a drag tax, because what they're doing is they're capping the rate of where the high rate the bands of where you pay tax. So basically, you get tax-free income at up to 12k, and then 20% up to 20k is marginable, but they've frozen them brackets. But minimum wage has gone up, so what this will naturally do, and wage inflation is going up about 6%. So what this will naturally do is drag some more people into the higher brackets of tax. So if you're not paying any tax at the moment, and all of a sudden your wages have gone up, it's drag you into paying some tax. So this is like a drag stealth tax. This is going to drag certain people into different brackets, especially again with the higher tax bracket, where that's been reduced from 150k where you pay 45p tax down to 125k, 49 something. I don't know the exact figures, but this is what you call stealth drag tax. It's going to drag some people into there because they're frozen it, and it's quite a maybe cheeky one. But look, the governments have got to do something about this at the moment. The big one for property investors, I feel, and this is the one that I feel is going to potentially, let's save this one for last, saying that. I'll come back to that. The big one for property investors, I think. Tax-free dividends have been halved. So at the moment, as a company director, you can draw down a tax-free dividends. This has just gone down and down and down. Gone are the days where you could draw up to the 20% bracket in a tax-free dividend. I think it got reduced to 6 first of all. Now it's down to 2. They're going to halve that again in a year's time, then halve it again in another year's time after that. So you eventually going to be able to draw out £500 tax-free dividends. So it's gone down for 2k, 1k, then £500. There's going to be, the energy cap has been capped. People's bills won't go above 2.5k. That's till next year, but next year they're raising that cap another £500. So it's still helping out households, but not as help as it was. There has been a levy on the big energy companies, but not as much as some people, like, well, myself included. Like, so obviously, I think an obvious way to raise money in this market. I'm not for taxing big companies. I'm not for attack big companies, because big companies take on big risks and they deserve to be rewarded off the back of the big risks they take on. So I'm not one of these like that really promote taxing big companies. But these energy companies are making record profits at the moment. So as a result, I feel it's very, like, the government was quick, especially in Scotland, to jump in and say we're going to do a rent cap. Well, already when landlords are squeezed with high inflation, with different taxations, they're freezing landlords' profits. So why they can't do this to energy companies when they're making record profits is beyond me. But they are stepping in and doing some of this, making some levies on them, but nowhere near enough, in my opinion. Put in the comments what you think around this, if you think that's enough. As I said, minimum wage up 9.7%, takes it over £10 an hour. Some small companies might see that as a bit of a struggle, especially with energy costs going up and a lot of the other effects going on in the economy at the moment, people spending less. This could put a pressure on some medium and small size businesses. Council tax is going to go up as well. So council tax had a bracket on it that could only raise it 2%. That's been raised from 2% to 5%. And it's down to the discretion, but you can bet that every single council will raise it up. Again, if you're HMO, a service accommodation provider, alongside your increased energy costs, alongside that will come your council tax going up, and it is looking to go up. So if you're an SA provider and you've got it in your sole name or in a small company, you can claim business rate relief. So don't forget that if you have got an SA, you've not already claimed that relief. You can only do that once per company or per name, so make sure you utilize that, but it's going to put a little bit more pressure on this sector. I think the SA sector is set to be a little bit more vulnerable depending where you are in the country. It's going to be macro and microeconomics going on with this, but for me, the SA, if people are not going to travel as much, if jobs are making job cuts already, look at Facebook and these big companies making job cuts. Like a lot of the contractors that get brought in by big employment companies are brought in because they need more employment, and they pay an extra premium on the contractors, where if they're doing job freezes, that might get reduced, and that will have a knock-on effect for service accommodation. So make sure you've got a good foundation in place if you're doing these strategies that are going to be high earning but not more high risk. So road tax is going up. Electric cars are going to have to start paying £25 per year on road tax. I don't think it's going to have a massive impact. I don't think anybody that owns a Tesla is going to say, I'm not going to buy a Tesla anymore because I've got to pay £25 tax on that per year. And yeah, that's pretty much most of the things that's gone on. There's a lot of other bits on there. There's a white paper, not white paper, there's a paper out, I can't remember what it's called, that discusses it in more depth. But I said I'm going to save the one I feel is going to be the biggest shift in the market for property investors. And this is capital gains tax. So capital gains tax, as it stands of today, you can claim £12,300 tax-free income. Like tax-free, I mean profit from a disposal of an asset. So if you dispose an asset like stocks and shares, it is lower anyway. It's like 10 and 18%. If you dispose of property, you have to pay more. Typically, everything in property seems to be taxed and pushed at harder. But as a property investor, if you dispose of a property, you have to pay 18 or 28% capital gains tax. And this depends on your personal tax bracket. So if you're high rate bracket, you pay 28%. If you're low rate bracket, you pay 18%. So there is a tax-free allowance every year of £12,300. This is going to be more than just over half, down to 6k next year, and the year after that 3k. So what I feel the effect of this will have on the property market, there's been a lot of old landlords that's got fed up with Section 24, fed up with the new compliance in place, fed up with all this that's going on. Interest will be going up, so even if they've got smaller mortgages, their interest rate will go up and their profits will go down. And a lot of landlords been exiting over the last 2 years. 49% of buy-to-let properties have exited the buy-to-let sector. Some of them have gone into SAs, a lot of them have gone into SAs, but a lot of them have just exited the private rental sector completely because people are just fed up, especially older generation. So when older generation started, it was just very much a little side investment, especially if you're like not professional property investor. And you got to bear in mind, most landlords only own 1 or 2 properties. So these people that's bought that for retirement, I thought, you know what, I have a bit of income coming in as a retirement, and now getting slapped with Section 24, more compliance, talk of rent caps, and all this other stuff that's coming in. They're thinking I'm going to exit. The market's been strong, and a lot of them have been exiting over the last year or two. We've bought quite a lot of properties from landlords over the last year or two, but a lot of landlords have been super ambitious with their price, and really a little bit, you can't blame them, but the market's been strong. They've been putting it on for a really high price. They've been putting it on market price, maybe even slightly above, just trying their luck. And as a result, some of them landlords have been holding on to this stock and didn't quite make it in time, still got it. Now their expectations are reversing. We bought a property from a landlord that wanted 69k for the property. It was worth probably about 75k. Was it 68 or 75k? But anyway, it worked out to be about 9% discount. What I like to buy in properties is a minimum 10% in this growth market. In any other market, I want 15%. So now we're going into a non-growth market and a vulnerable market. I want it back above 15%. But over the last 2 years, it's been at 10% purely because it's been very difficult to find deals above 15% consistently. We've found some, but not consistently. And the opportunity cost of the capital growth you was getting and the income you was getting didn't outweigh you hanging around trying to wait for this magic deal that's going to turn up. So we lowered that bar down to 10%. We've now rehired it back up. But as a result, that deal we was looking at before, direct to the vendor, landlord, they wanted 68k for it. Didn't work for us, worked out about 9%. We wasn't dropping, even though it's close to the 10. We was like, no, it's just not quite right for us. And then when all this happened, what happened with a lot of these landlords as well is a lot of them were on standard variable rates. So as a result of being on standard variable rates, because they thought it was going to sell, now as the interest rates have been skyrocketing, they're now really feeling the pinch. So their motivation is shifting massively. So I feel this is going to create even more of a buying opportunity. I think a lot of landlords have been sitting on the fence even before COVID, thinking, look, Section 24, I'm going to sell anyway. A lot of them read it out. Because the market was going up so much as well. I'm thinking, if I sell now, say if it goes up another percentage. Now they've realised it's not gone up. It's not going to go up. A lot of them, I feel, are going to try and rush to exit before rates get too much higher, before they lose their capital gains tax allowance, and a number of other things. So I believe we're going into one of the biggest buying opportunities we've had either in the last decade or possibly even a lifetime. Look, at the moment, we're just doing a deal at the moment. We're refurbing a deal that's 24% below market value. Really hard to get these deals done over the last 2 years. So what you would have got from the previous 2 years would have been higher cash flow because the interest rates were so low and higher capital appreciation. Every market is a way to buy it. At the moment, you're going to buy a lot more capital in them, and you need to buy capital in there. You need to buy capital in it in proportion. You need to price in how much you think your area might drop, because there's macro and micros in every area. Even a town where certain parts will drop hard, certain parts will be pretty neutral, and some parts that will only drop a little bit. So you've got to try to do an informed decision on your area and do the analysis and understanding of how your area works, a price per earnings ratio, so you can make an informed decision on where you think that will be. And then you base your asking price, you just price that price in where you think that's going to end up. So for me, I think in the micro spot that I'm investing in my area, you might look at maybe dropping to, I reckon there might be a 5-ish% drop, maybe pushing towards a 10 maximum. So if I'm pricing in 15% plus, it gives me a healthy margin in there to absorb any shocks. The cash flow is slightly lower, but the cash flow is still 10 times, 100 times, million times better than losing money in the bank at the moment due to inflation. And if you just sit on your hands and wait, the amount of money you're losing to inflation, say you got 25k in the bank, you wait a year, inflation as it stands at the moment above 10%, you're going to lose 2.5k guaranteed. So I'd rather have a lower income guaranteed, because the way we rent properties, we get guaranteed income on our rent, and we get pretty certain long-term tenants, whether it's social housing or not. We've got little methodology to do that. So I'd rather have guaranteed income, even if it's lower, then have a loss over that year. I don't know about you, put in the comments what you'd prefer, but I know what I would prefer. And in a year's time, what you want to be doing, a lot of people say wait to see what happens in the market. The thing is, if the market keeps on crashing even more, the interest rate will go up even more. So even though the prices will come down, the interest rate will go up. So if you buy it correctly, it'll balance itself and even itself out anyway. And it's definitely about building a delayed gratification at the moment as well. You want to factor in you need cash flow, but you need plenty of equity built in, either from forcing the value up or buying fantastic deals. So this is my views around it. Love to hear your views in the comments. Look, my why is to live on my terms. My mission is to help as many people live on their terms. So if you haven't already, hit that like button, hit the subscribe button, and hit the bell icon so you get notified whenever we do videos like this. Please share it out for somebody you think they'll find it valuable. Remember, if you don't evolve your ideas, you never live on your own terms. So evolve your ideas, live on your own terms. Have an amazing day. So